Okay, hello everybody. Welcome to Korean Atlanta Mentorship. It is 11:21 p.m. right now, and I am so sleepy. But you know what? I want to brainwash myself before I go to sleep to success, and I think some of you want that the same because I remember I read comments about how some people write like, I just want to do velocity banking, but I can't get myself to do it. So just listen to these videos on loop over and over again while you go to sleep, and hopefully I'll be able to subliminally brainwash you, right? And after you're able to absorb the ideas and knowledge in velocity banking, what will probably happen is if you are able to apply it is by the end of the month, right? So you have your beginning balance of your checking account, $0, and then you apply your money to all of your debt and have $0 with the help of a line of credit, right? So this is kind of like one part of what velocity banking would look like when you get your bank statement. Beginning balance zero, ending balance zero. And in fact, what's funny is that I talked to a banker like yesterday, and she was like, "Yeah, just leave a penny there because if it's from in $0 too long, then they might like think your account is soon to be deactivated, and you might not be able to access your money freely." Luckily, that hasn't happened to me, but I might just leave a penny in there just for good measure, right? So this is just one part in real life how velocity banking would look like. And so unlike the average American who freaks out about a zero balance, if my debt, I'm sorry, if my money isn't being applied to debt, it's just in a checking or a savings account, right? Then the bank is winning because they're just making more money off of interest, right? And so this part two of what should happen is again, we're going to have zero savings with the help of something called a line of credit. So you may have a balance, or I'm sorry, a statement balance for your line of credit, and it should look like something like this. Maybe you got a balance, you put your entire paycheck in, again, all of your pay, whether it's your YouTube pay, rental income pay. Hey, you may work a W-2 job, put all that in there, take your expenses out. That's where purchase and other charges is. And then you get charged interest for using that line of credit. But hey, you know, um, I don't really care if this is a 10% interest rate. If I'm just only paying $15 to be able to easily manage my cash flow, I'm in, right? So there's two parts to this in real life, two statements that are important. Number one is that after the end of the month or the when you get your bank statement balance, I don't want to see any money in my checking or savings. Okay. Number two, if I am paying off debt, then I'm going to make sure all the reason why this is $0 is so that I apply all of my money into the debt so I can pay off that debt quickly, get increase our cash flow, and minimize this interest. I mean, think about it. If you're putting 18 grand and you're spending 12 grand and all you got to do is pay $15 just to manage your cash flow, wouldn't it be worth it? Even though it's a 10% interest rate, whoop de doo, 10%, right? I know a lot of people freak out about that, but I don't freak out about 10%, just as long as I know I have this thing called cash flow, right? So now let's take a look how we would do velocity banking in Excel. And you know what's funny? In practice, velocity banking only takes like 1 second. It's literally like a click on your bank's website the moment that you get paid, and everybody's like thinking, "Oh my goodness, I need a spreadsheet to do this. I need a spreadsheet to do this." But you don't. The spreadsheet is to help you understand, and in order for you to understand to the best of your ability, make the spreadsheet yourself, right? How hard is it to write a budget, income, expenses, savings, right? And then you make sure that when you have your savings, or I'm sorry, your expenses, you have an expense breakdown of every single debt that you have, because the whole point of the strategy is to eliminate debt. And the more debt that you eliminate, the more cash flow increases, right? And so we got 10 credit cards, we got a mortgage. So if we eliminate all this, we will increase our cash flow. Whereas with our other expenses, which we call general expenses that are not directly tied to debt, food, gas, insurance, we could just lump them up in one bucket. Now, I know there are other people who do these budgets and they want to list what they pay for every single thing. I'm not a real big fan of that just because I feel like I'm trying to make this as easy as possible. And there's a lot of value in just making it easy, right? So again, I don't need to list like every single, I just know in general, I paid about $2,500 in expenses. Now, I know I've done this example before where we have high income, but there are a lot of people out there who have high income and can't manage their cash flow. Like random people email me. They watch these videos and email me their spreadsheets, and they make a lot of money and they're still broke. There are a lot of people out there who make a lot of money, but because they don't understand cash flow management techniques, they become broke. And I think there's a statistic that says that I think 85% of pro athletes or something like that become broke 2 years after they retire. Isn't that crazy? That's crazy, right? So we want to make sure that as we're making more money, that we understand how to manage our cash flow. And the easiest way to manage our cash flow is make sure that debt doesn't go out of control, right? We pay off debt, we have our cash flow, and we're good to go. So here we have velocity banking. And what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. In order to do it, you only need two things: a budget and a line of credit as your main operating account, right? So we got a budget. Now we need a line of credit as a main operating account. And there's different types of lines of credit. There's personal lines of credit. There's home equity lines of credit. I'm pretty excited because I feel like I'm going to get a huge home equity line of credit soon. Huge, right? And so I'll keep you up to date on that. When I get that huge home equity line of credit, I think it'll be first lien. But I've talked about this in channel that I don't really recommend first lien home equity lines of credit to simply replace your mortgage unless it makes sense, right? You don't want to just do it just because the internet tells you to. But I'm going to get a first equity line of credit because all my debt on the house is paid off, and so now it's like having access to a, I don't know, $300,000 or $400,000 credit card. That'd be cool, right? But let's just assume in this case we have a $200,000 home equity line of credit. All that means is that you almost get this huge credit card because you're putting your home equity as collateral to a bank or a lender, right? And so what we're going to do is assume two things. Number one is that we have the same income because we are assuming, right, that we don't need more income for the strategy to be powerful. We don't need more income. Number two is that we're going to do the exact opposite of what mainstream finance teaches us. And this is the part where most people feel uncomfortable, where it's like I got to have 3 to 6 months of savings, right? You talk to my parents or whoever, and you show them, oh, zero savings after every single month, they'll like freak out. Oh my goodness, you need 3 to 6 months of savings, right? And if you get that bad vibe, that bad that emotion where people freak out, then it's going to be hard for you to do. That's why I got to brainwash you to do this, right? And I brainwashed myself maybe like, I don't know, 2 years because I couldn't even get a line of credit. Just thinking, hey, I'll pay off my debt once I'm able to buy a home, right? Or whatever, any other type of debt, student loan, auto loan, any type of loan, any type of credit card. All right. So now let's go ahead and copy the expenses. All right. And then I'm going to go ahead and copy the credit cards and the all the other good stuff, the mortgage, other food, insurance, gas. And then now we have cash flow, which is income minus expenses, right? And so our cash flow looks exactly the same as our savings, but we need to make our line of credit as our main operating account. And once we do that, then we'll see this number increase by a gajillion, right? Increase by a gajillion, okay? Brainwash yourself into thinking that you're going to increase your cash flow by a gajillion. I need to make that into a T-shirt slogan or something. I don't know. Maybe someone else can come up with a better slogan for me if I'm going to sell some t-shirts, but I'm not because I'm a little bit lazy. Okay, so now if we have some credit cards, again, credit cards have the highest interest rates. They take up the highest cash flow. So you just want to move their credit cards first usually. And this is $167,000 of debt, right? $167,000 of debt. We're good. We're good. Now, by simply moving the debt, what do we do to these payments? Just by a debt transfer, oh my goodness, 0.000000000. So all these 10 credit cards have become zero in the payment, and we increased our cash flow by $5,345.84. So here, we were probably your broke, average pro athlete type of millionaire or lottery winner, where we got a lot of income, lots of expenses, and no other way of managing our cash flow. We're here, we're not on the struggle bus anymore. We're on the cash flow bus. We're on the party bus, right? We put our entire income into the line of credit. And this is the extra strategy. income into line of credit, expenses, right? Expenses. How do I say out of? Out of. Maybe it's this one. Oh, whoops, I screwed up. Out of line of credit, right? And it doesn't mean you have to get rid of your credit cards. In fact, I would still use your credit cards because credit cards are so cool that you can charge, for stuff on them and then like wait a month to delay paying the interest for those credit card purchases as you're paying off debt, right? So I always do that where I pay for stuff with a credit card and then wait a month to pay it off completely in full so that the credit card doesn't charge me interest. And then, once I pull out that money from a line of credit, I'm able to pay off or, delay the interest that I would normally pay if I'm just using a home equity line of credit. Because if you pull out money from home equity line of credit, you get charged interest on day one. Inevitable, right? This is why home equity lines of credits or home equity lines of credit do not have bonus points like credit cards do because they're everything's a trade-off, and hopefully that makes sense. If not, I'm a little bit sleepy, so don't worry about that. Okay, so now that's $167,000 of debt, and again, entire income into the line of credit, expenses out. So you put your entire $9,644.49. Brainwash yourself into believing that, because when you have your banking statement, again, it's gonna look like this. Maybe you don't make this much money. That's fine. Take out the one right here. So $6,536. And then minus $6,536. And then the beginning should be zero. The end should be zero, right? I guess you'd call this the alpha and the omega, right? So let's keep brainwashing ourselves. And then our expenses are going to come out. So how's that going to look like? All your paycheck in, expenses out, and then after every single month, oh my goodness, you know, you get charged a little bit of interest, and then you get your new balance. So our new balance is going to go down by about $5,345 plus the interest, right? So you see this right here, the periodic finance charges. We're going to go ahead and calculate that. Let's see how that works. So this is the periodic finance charges right here. Again, I use the same formulas over and over again. Oh my goodness, these are so simple. Paycheck in, expenses out. To calculate the next month's balance, it's the previous month's balance plus the previous month's interest minus this cash flow number, 5345.84, right? And we're not on the struggle bus anymore. We're on the cash flow bus. We're on the party bus. Cash flow with no savings. And for a lot of people, that doesn't even make sense, but no worries. All right. So now what we need to do is calculate the average. So you see this section right here where it says periodic finance charges. This is calculated by the average daily balance. And so what you do is you get that, you multiply it by the interest rate. So that's um, point 0.1, right? And then you divide by 12, right? So 10% divide by 12, and then that's the amount of interest you have to pay for the month. And so all you do is just copy and paste these formulas. Wow. And let's see how long it takes us to pay off this debt. And as you can see, this $167,000 took 37 months to pay off. Oh my goodness, 37 months to pay off $167,000 of debt. 37 months, 167K. You see how easy that was? You just brainwash yourself to pay off debt, brainwash yourself to success, brainwash yourself to believe that yes, after every single month, the balance of my checking account will go to zero. And if I have savings, if I need savings, again, our line of credit is our savings account, right? So if we need more than, let's say, $2,500 in our general expenses right here, just pull out a couple of dollars if you need a couple of dollars extra more than the 2,500. Pull out $500, and then next month don't spend as much. And so this is an average, right? So after every single month's going to go to 2,500, we pay less interest. It's so easy. I cannot believe they invented it. I think that's like a slogan for one of those infomercials. Or is that from The Simpsons? I think it's from The Simpsons. But again, entire paycheck into line of credit, expenses out, periodic finance charges, which is what this interest column is. You pay some of that interest to use that 10% line of credit. I don't even know how I'm paying $15, but maybe, well, that's because the previous balance isn't like $100,000. And then we have the new balance of $338.98. So again, brainwash yourself, income into line of credit, expenses out of line of credit, because that's essentially what velocity banking is. All it is zero savings with the help of a line of credit. Now, I know some of you are out there thinking, how do I get this line of credit? Oh my goodness. There are tons of places where you can get lines of credit. I'm going to tell you the secret that you have to know this. Banks don't lend money to people who need it. So if you're in a jam like this already and you don't have a line of credit, they ain't going to lend it to you because they know that to get max profits, you got to lend money to people who need it, right? I mean, think about it. Like, if you were a landlord, would you want to rent a property to people who don't have the money? No. Same thing with lending money. You don't want to lend money to people who don't have the money. It's kind of weird, right? Like, it's kind of like thinking I'm going to a restaurant without even though I'm not hungry. I already have food. Like I'm going to a restaurant even though I have food, right? That's how it is. But that's we got to understand how the game is played. So again, remember that banks don't lend money to people who need it and the actual strategy itself is income into the line of credit, income into the line of credit, all your income, expenses out, purchase and other charges, that's your expenses out, right? Expenses out of line of credit, rinse and repeat again. And so after every single month, maybe you might have a penny of savings just so that the banks won't shut down your account. I don't know if that's true or not, but that's what the banker told me. But the alpha and the omega, the beginning and the end should be zero. So brainwash yourself to do that if you can't do it already. All right. And then today we're gonna just cut it short. I don't want to. I got to go over amortized loans in details again, but I always love, sometimes the reason I cut the video short is because I always love going from a penny to $5,345 without doing anything. Right? Didn't make more money. A lot of people believe I got to make more money, and then I'm not in a struggle. No, no, no. You got to learn how to manage your money more effectively, right? To pay off your debts quicker while being able to sleep at night. Because there are a ton of people out there who, let's say, use the Dave Ramsey method and they stress out. Because what is Dave Ramsey always teaching you? Eat beans and rice. Whereas with this method, I don't gotta eat beans or rice. I'll try to eat at least the healthy, organic. Uh, well, what's something that's really good but healthy for you? I guess the organic beans and rice. So we're gonna level it up, right? Organic beans and rice. That's what we're gonna eat. All right. Well, that's it, everybody. Have a great day. It is 11:38 right now. Again, brainwash yourself to sleep and dream about velocity banking. And some people say it's just a cult. It's not, but I did get the AI to draw me a picture of a velocity banking cult. So who knows? This society is kind of crazy. One day this cult might appear. I may be a cult leader, I may not, but you gotta, you know, we always gotta preach it, right? We always gotta preach it every single day. That's how we become successful, is all the little steps that we take to get there. And I'm gonna show you some crazy things soon about myself that will probably blow your mind. And you're thinking, "Oh my goodness, did you really do that?" And I'll be like, "No, man, it was just Photoshop. It was just Photoshop, just so I can have people watch these videos." I'm just kidding. All right. Well, have a great day, everybody, and we'll speak next time.